Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is incredibly well timed with the news. So Lori Calvasina with this at RBC and with her work at Credit Suisse over the years. Lori, I've never seen this where once again, VIX out three big figures, and I just don't see the sweat that I should see with a VIX out three big figures. We're just weaned. We're hardwired buying the dip, aren't we?
So it's interesting, Tom, if you look at AAII net bulls, they dropped like a stone, sunk like a stone, I guess I should say, in August. And the last time we saw that was the first quarter of this year, which predated the tariff sell-off that we got. But in retrospect was an indication that maybe that buy the dip mentality wasn't going to be rushing in to save the day. So, you know, it's funny, Tom, we're having sort of a red day, or red morning to start the week. I'm a little surprised, by the timing of it necessarily, but, of this particular day. But that being said, we had been telling people, back in August, AAII had sunk, valuations were stretched, and seasonality is poor in September and October.
Paul, I've been remiss in mentioning this, the NASDAQ 100, a negative 1.5% this morning.
Absolutely. So let's just start with valuation. How are you thinking about valuation here? Is that a cause for concern as we think about it?
So I think it is. And if you look at just plain old-fashioned vanilla forward PE multiples, a market cap weighted S&P 500 number has been bumping up against recent highs and started to stall. We've seen the same thing on the NASDAQ 100, even if you look at it on an equal weighted basis. And the way we put it is that we sort of hit a valuation ceiling and things get a little bit tougher. And it really just represents a headwind that you're kind of not really vulnerable to good news anymore, but you are vulnerable to bad news. And this morning, the bad news seems to be the bond market acting up.
Yeah, exactly. We've got the 10-year Treasury yields out about 6 basis points, 4.29% here. So we do have a Fed that presumably is going to start easing. How does that play into your outlook? So
it's a great question, Paul, and I'll tell you, we have sort of a top-down valuation model where we project where the PE should be at the end of the year on a trailing basis, and three inputs into that are inflation, the Fed, and 10-year yields. The Fed cutting, getting some relief there should give you some upward lift to that PE, but inflation moving up should give you some downward pressure, and we'll see, TBD on the 10-year yield, but it tends to be more of an inversely correlated factor. So even if we have cuts coming, if 10-year yields are moving up, the way the math works says, at best they sort of net out. At the end of the day, if you throw inflation in, it may give you some downward pressure.
Right. So how do you screen here in this kind of market? Again, most people call it an expensive market, but it's supported by some pretty solid earnings out there. How do you screen here? Do you screen by industry, by factor? How do you think?
So we tend to do less work on factors. I tend to do more work on sectors and industries. And I'll tell you, I put another chart into the weekly this week. I'm sounding like a broken record, but it comes back to the financials. And we did some work around ISM prices paid last week, just looking at its relationship to the stock market. And then I ran it against sector performance. And guess what? Financials comes out as your top sector if that sort of leading indicator of inflation is moving up. Things like healthcare and staples tend to underperform.
Do you have a vector of inflation higher, or is it a vector level persistent?
So, our economists are looking for inflation on a headline basis, I think, to move up to around 2.9% at the end of the year. So nothing crazy like what we saw in sort of the, kind of post-COVID era or even back in the 70s, but, certainly far away from that 2% target that the Fed has. And, I think this is just going to be the question. We've got this real test coming up. We know the inflation pressures are there. We don't know what the demand picture is really going to be, but we know that tariffs are creating some upward impact.
Okay, so fold it into sectors. I mean, I like this idea. How quaint, sectors. If I have a persistent inflation, which sectors win? So
you've actually been seeing energy act a little bit better, and that's another one that typically, we've just noticed more anecdotally, less so in a study like the one I mentioned. But if you expect to see, sort of inflation pressures mount, we often will see the commodity sectors do quite well. We actually upgraded materials the last time we made sort of our quarterly changes to sector bets. And we liked the valuations there. Our analysts were pretty enthusiastic. There are clearly some tariff headwinds, but there's also a lot of, kind of dollar benefit from a weaker dollar.
How about just the concentration risk in this market? Every once in a while, like every other week, maybe it gets called out somewhere that, boy, it's 10%. A handful of stocks are really responsible for the performance of the S&P 500. How do you guys think about that?
So we have one chart in our deck. This may be the first time I've ever talked about it on TV, but we look at those top 10 market cap names in the S&P 500 as a percent of net income of the S&P, and then we compare it to the percent of market cap. And what we're seeing is that the market cap has exceeded the net income percentage, but that gap has been pretty stable in recent years. So you're getting the premium. I will tell you, in August, it did seem like the gap got a little bit wider between the two. Nothing super alarming, but you could have made the case looking at that chart that the concentration, maybe got a little bit of ahead of the relationship that had been in place the last few years.
So what do you, come on, it's September. I believe the quarter ends September 30. The president can't change that, right?
I don't think so.
Okay, thank you.
If he wants to.
But September 30, JP Morgan is October 14th. We got earnings wrong last time and the time before. Are we reduxing it again?
Well, look, I will tell you that on earnings, this last reporting season, I would sort of fade the idea that it was the best reporting season ever. I think one of my competitors actually said that. And if you go through and you look at the data, a lot of it was backward looking, and it was because of all these tariff impacts that weren't as bad as what people had put in the last reporting season. And guess what? Everybody figured that out starting in May, right? And so it really had already gotten baked in. It was a very sort of backward looking beat. If you look at, kind of the forward-looking growth expectations for 2026, we only saw them go up. And if you look at that percentage growth rate, 26 over 25, it only went up for two sectors, tech and materials. It went down everywhere else. That doesn't, to me, that doesn't scream that we just injected a bunch of optimism into the outlook.
I have one final question. You're so healthy. For your children, are you going with Veda cheese or Kraft Singles 2% milk American cheese?
We do not do the Kraft Singles. We do the mozzarella sticks. We're big mozzarella.
Big mozzarella sticks. Those are very big. Thank you.
Yep.
Yeah. The little one likes those.
Yeah. Got to keep them happy. Got to find it.
Who does mozzarella? Should I go long mozzarella sticks?
But we also have a daily dose of chocolate milk. So.
Very good. I like that idea.
Yeah, I like that too.
Remember Bosco?
Yeah. Sure.
Come in, you'd make Bosco. Your mother, you're too young to remember. I remember powdered milk. Talk about death's door. Lori Calvasina, thank you so much. Greatly appreciate it. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Henrietta Treyz briefs us, avoiding the speculation of the weekend on the president's health. Henrietta, if we have a War Department, what is the symbolism of going from Harry Truman's Defense Department back to a renamed War Department?
I think the most important takeaway here is that Congress is about to reinsert itself into the conversation for the first time in a month. Recall that the House left early at the end of their scheduled work period. They called it quits early because of the hullabaloo around the Epstein files. So now the president is going to be facing a serious litany of competition from Congress when they get back to talk about Mirren, the firing of Cook, the firing of the Bureau of Labor Statistics Commissioner, the Epstein files. Why not rename the War Department? It's a great way to have another way to control the narrative, which is going to be critical going into a potential government shutdown. The fact that the Federal Court of Appeals ruled that his IEEPA tariffs were unlawful, and a whole host of other things that he hasn't had to address for 5 weeks and is going to have to starting today. So a great way to have a counter cycle.
Who in Congress is going to drive the agenda over the next several weeks and months here? I don't know how this is going to play out.
Well, really, we're going to see the government shutdown probably start to drive the narrative pretty quickly because it is the most pressing issue for them this month. We're going to do the National Defense Authorization Act in the Senate this week. We'll get the Mirren confirmation hearing in the Senate Banking Committee on Thursday. The House is going to take up their NDAA next week. those let's just avert a government shutdown narratives are really going to drive, because that's the most urgent, pressing issue. There will be press conferences with Republican Congressman Massey over Epstein. They'll try to get that bill to the floor. The senators are going to talk about, whether or not they can cobble together an appropriations bill and pocket rescissions. The driving narrative is really going to be the legislative agenda. I love using the calendar just for that purpose. It's all about a shutdown.
So, Henrietta, I feel like I ask you this question every 6 or 9 months. What is the calendar look like as it relates to a shutdown? What is the timing and the milestones we have to pay attention to?
Basically, we need them to come to an agreement to keep the lights on by September 30th at midnight. Asking any more than that is probably unrealistic. The House and Senate haven't come to an agreement on all 12 appropriations bills since, I want to say, Bill Clinton's era in '96. So, any hopes of camaraderie and bipartisanship have flown. They are not realistic. But a short-term stopgap that's going to probably weigh on the legislative agenda another 1 or 2 times for the rest of this year is what we should expect. I don't think there will be a shutdown. My odds are 25%. That's pretty high for me, to be honest. But that's because the administration is doing something called a pocket rescission, where they try to cut spending that Congress has already appropriated. But the shutdown would start at 12:01 on October 1st.
And too short a visit. Let me squeeze this in. I got like 8 ways to go here, folks. We literally could do 2 hours with Henrietta this morning. How does the imagery, the pageantry play of Putin, Xi, Modi, all the different, Bloomberg has a beautiful image of Xi and Putin, best pals, best buds. How does it play in your world, Henrietta?
In my world, which is very much tariff world, it shows you the negative consequences of tariffs. You penalize our global allies, NATO allies. You push India, who we've tried to foster a relationship with for 30 years and have made incredible strides considering they're neighboring China, is really, really telling. And the part that's really striking is how personal the president makes his relationships with all of these men, whether it's President Xi, President Putin, or Modi. The president has gone out of his way to explain that he can fix the Ukraine-Russia war on day one, Gaza on day one. He has an incredible relationship with President Xi, an incredible relationship with Modi, and yet we see precisely the opposite, this relationship actually not being valid and driving those men together because of the tariffs. It's a obvious consequence, but nonetheless unintended from the administration.
We got to get you on daily. The news flow extraordinary. Henrietta Treyz, thank you so much. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is the interview of the day. It is Ernie Tedeschi of the Budget Lab at Yale on your grocery bill, on the tariffs on Vespas, the tariffs that are happening. The Budget Lab at Yale, absolutely expert under his leadership. Ernie, what inning are we in the impact of tariffs upon us all? Is it like the second inning, or are we like along the way?
I think that we're like in the sixth. We're not quite at the seventh inning stretch yet. We are starting to see impacts on actual economic data. So core goods prices are about 2% higher than they would have been based on pre-2025 trend. And that suggests that, like, as of June and July, consumers were paying about 3/4 of the tariffs, and probably American businesses the rest. There's very little evidence that foreign producers are paying them right now. So, look, there's obviously more to come. We expect announcements on things like semiconductors, pharmaceuticals, et cetera. But, we're beyond the beginning of the game.
Ernie, I've been talking a lot about the microeconomics, the dynamics of the substitution effect, where Paul wants a Vespa and instead he buys a Harley. I get that idea, but there's also an income effect. Are you at the Budget Lab at Yale? Are you seeing a diminished appetite for growth? Are you seeing a diminished nominal GDP because of this tariff tension?
It's tough to see right now because consumers and businesses are timing the tariffs, and they're still trying to sort out what we're all trying to sort out, which is the best time to import things, the best time to buy. So, we've seen big declines in consumer spending in certain months, especially late last year, early this year. That seemed to definitely be anticipatory tariff effects. But then they're followed by big spikes as there is a tariff pause or tariff relief, that's temporary. And so people try to get their spending in. So it's really unclear what the ongoing effect is, looking through all that noise. We think that ultimately the tariffs that have been announced will be the equivalent of, about $2,400 off of the purchasing power of the average American household. But that's going to take about 2 years or 3 years to get there.
Paul, the Harley that's most like a Vespa is a Harley Softail Slim.
Oh, okay.
In crimson, stone-washed white, and pearl.
Sounds solid.
Sounds solid for the New Jersey beef.
I got the Vespa pre-tariff. Ernie, talk to us about it, kind of the nature of these tariffs. Is it as the White House would suggest, a one-time price adjustment versus maybe a beginning of a inflationary trend?
So that's also really hard to parse right now, because on the one hand, the textbook will tell you that this is a one-time price adjustment. On the other hand, given the chaotic rollout of the tariffs and the gradual rollout of the tariffs, even if it is a one-time price adjustment, because it's so, incremental, it feels like true inflation to people, because they get a little bit one month, they get a little bit more the next month. And so it doesn't feel like one time, it feels like it's this ongoing thing. Plus, there is the Fed concern that this is going to spill over into supply chains and actually be more persistently inflationary. We haven't seen evidence of that yet, but, like I said, it's not the beginning anymore, but it's not the late game still. So we're still looking for more evidence.
Well, on the other side, Ernie, I guess it is in fact true that the government is raising tariff revenue. That's correct?
No doubt. We've raised almost $90 billion this year from just the new tariffs that have been announced in 2025. That's not total tariff revenue. That's just from the new tariffs. That is substantial. We think that is consistent with $3 trillion in new tariff revenue over 10 years. If the tariffs are kept in place, nobody should downplay that. That is a major amount of revenue.
Just to tie it together for our listeners and viewers, of that, $20 billion a month, 60 to 80% is being paid for by consumers and the rest by American businesses?
So that's what we think. So this is a tax on Americans. Let's be clear about that. The other thing that's interesting so far, and we're going to start incorporating this into our modeling, is that some tariffs are coming in much lower than we expected. In particular, Canada, where 92% of Canadian trade is now tariff-free, which is much higher than we expected given USMCA. Right. So it appears that Canadian firms and American importers are taking advantage of lots of different, I won't say loopholes because I'm sure it's all legal, but available authorities to bring things in tariff-free.
I know in New Haven, Ernie, you're just doing pizza to take out. I mean, that's the way you roll at Yale. But I looked at groceries this weekend, and it's just jaw-dropping how everything's up. Are the price of groceries and produce up because of your world of tariffs?
So a little bit. So a couple of things. One, we get a lot of produce from Canada and Mexico in particular, and fresh produce especially falls under USMCA 90% of the time. And if something is USMCA compliant, it's tariff free. So Mexican avocados are probably not very sensitive at all to tariffs. The other thing is that there's a lot of non-tariff stuff going on in groceries right now. Beef, obviously, that's a whole thing, but that's got very little to do with tariffs. That has more to do with worldwide droughts, et cetera. So I think that the tariff story is more on the good side, things like appliances, electronics, furniture, rather than groceries.
I don't want you to front run your academics, but when you have a meeting today with Ms. Gimbel and the rest, what's the thing that you're thinking about at the Yale Budget Lab?
So we're thinking about, we think about lots of things all the time, but I mean, the thing that we're thinking about most is, where do we go from here in terms of tariff revenue, because we're a fiscal and a macroeconomic think tank.
Right.
So, we've done a lot of work on the macroeconomics. We're trying to think about ways that, we're, number one, how much are tariffs actually going to raise when all is said and done? Two, is there a better, more efficient way of raising the same amount of revenue? Because look, like I said before, you can't dismiss $3 trillion in revenue over 10 years, but is there a way to raise the same $3 trillion in a way that doesn't hurt business investment the same way?
Ernie, thank you so much. Ernie Tedeschi, great work. I really can't say enough about it. My great folks over to the Budget Lab at Yale. Just really, really brilliant work. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Fatima Boulani, I need like 6 bullet points to move forward here. You've been doing this since Thomas Weissel. I want you to explain, this weekend, you're at some family get-together, and everybody's AI, EIEIO. What's the biggest misconception mere mortals have about your world at Citigroup? What's the single thing we most get wrong about tech that you cover?
Look, thanks for having me here. To explain what we're working through right now to my 2-year-old, which I have one, and the EIEIO lands very well because my mind is very preoccupied with nursery rhymes, is, look, the most consequential technology paradigm shift in our lifetime. And, there have been a lot of analogs made towards, when the corporate internet broke out onto the scene 25, 30 years ago. To me,
I have said this, it is so much like late 94 or 95. You're saying it's bigger?
It's bigger, it's badder, it's far more consequential because you've had a democratization of computing that has compounded over the last 3 decades, right? Your iPhone today is 5,000, maybe 10,000 times more powerful than the first iteration of the computer that IBM spun out, 30, 40 years ago, right? And so just the sheer power of computing infrastructure, and you see this from the hyperscalers, it's just at your fingertips. And that's really what we think is going to move the ball forward. And, I was chatting earlier, we are hosting our flagship conference in New York City this week. We have, close to 500 investors from some of the biggest asset managers.
Are you guys taking every room at the Waldorf Astoria?
I wish it were the Waldorf Astoria. It's the Hilton, though.
So, I'm just looking at your lineup here. Everybody in tech, TMT is going to be there. Tech, media, telecom, everybody's going to be there. How do you wind the AI theme throughout this 3-day conference that you have?
We think about it from a supply chain perspective, so to speak, right? So my colleagues within the tech franchise, between the individual who covers the media names, the individual who covers the telecom and tower names, myself, I cover enterprise software, which is, dare I say, some of the sexiest places to be in technology. So just thinking about the AI value chain from a supply chain perspective, and I will tell you that the number one burning question, the most polarizing debate right now, is how are companies in the software sphere going to be monetizing this trend? We understand, what's going to happen, and we are understanding and witnessing what's happening in the power and utility space. AI-geared data centers are just hoovering massive amounts of power, right? And data center infrastructure and all the adjacent investment around that. So what does the downstream monetization path look like? And that is the single largest debate. And so that's sort of what we're endeavoring to do at the conference, weaving a lot of these themes from a subsector perspective.
Is Apple going to be there? Maybe they'll learn something. Apple's so far behind. With you, Tyler Radke, and the rest, when you and your team look at how Apple's quote-unquote behind on AI, what's your response to that?
Look, we're not ruling Apple out. Our perspective is purely from the enterprise software standpoint, right? So how are organizations standing up an AI strategy where they can operationalize AI in the sense of how do we improve business processes, how do we improve customer satisfaction, right? So our perspective in our lens is very much geared towards how very large entities and professional organizations are going to be deploying this technology, as opposed to, from a consumer angle, if you will.
Who loses in AI? Do we have them? Because I'm always asked the question, who wins, how do I play it? Who loses in AI?
I'm glad you asked. My team and I, we've had a big piece come out overnight. Between Tyler and myself, our team covers close to 80 software stocks, right? So there's plenty of nuance to be had in thinking about how this is going to be impactful. There's going to be some winners, there's going to be some losers. And the way we've thought about it is, if you stratify our software space between applications, so the household names there are Salesforce.com and Adobe, infrastructure, which is more or less cybersecurity, and some other names of where you're building your IT environments with these capabilities. We generally think the infrastructure software space has more stickiness and teeth to it. So in broad strokes, there is a level of insulation around the infrastructure names, whereas application, there's absolutely trepidation, absolutely fears around that.
I got to squeeze this in. You're having a cup of coffee right now with Aravind Srinivas, Perplexity. I'm absolutely blown away at the game-changing nature of that, the software around it. And what's your number one question to the leadership at Perplexity?
Look, it's really, how do you continue to innovate in a space where, frankly, there's a Cambrian explosion of sorts going on in the AI world. Patent pending. And the confluence of the rush of VC capital, the unabated appetite to become the number one standard bearer in AI, because, to the victor goes the spoiled and the massive amounts of market share, right? So we are absolutely in the gold rush phase right now. So really, I think the most inquiring minds will want to know, how are you keeping up with the rapidly changing pace of technology, preferences, and procurement?
Way too short. You got to come back after the technology conference to brief us on this. Fatima Boulani is co-head of U.S. software equity research at Citigroup.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.